In this video, I want to talk about how political uncertainty affects market behavior and investor confidence. How political uncertainty affects market behavior and consumer, or rather investor confidence. So, political uncertainty can significantly impact market volatility by creating an environment of unpredictability that affects investor sentiment and decision making. So here is how political uncertainty contributes to increase market volatility. Number one is investor nervousness. Investor nervousness. In this case, we need to consider unpredictable policy changes. Unpredictable policy changes. A political uncertainty often leads to unclear or changing government and policies, which can make investor nervous. This uncertainty leads to market swings as investor reacts to potential risks like tax changes, regulatory shifts, or new economic policies. We also need to consider fear of economic disruption. Fear of economic disruption. And so political instability can trigger fear of economic disruption, such as inflation, recession, or trade disruption, leading to a volatile market environment or volatile market movements. Number three is market sentiment and speculation. Market sentiment and speculation. So in this case, we consider speculative behavior, investor speculative behavior. So political events like elections or geopolitical tensions, can drive speculative trading as investors try to predict the outcomes and their impact on the market. This can help, or it can equally, lead to heightened volatility, and market participants react to rumors. As market participants, usually they react to rumors, and they react to news, and even equally react to speculation. There's also mood swings. When it comes to mood swings, political uncertainty often leads to mood swings in the market, where small changes in political events can be outsized. It can have an outsized effect on stock prices, particularly in sensitive sectors. Number three is corporate earning concerns. Corporate earnings concerns. So we talk about policy impact on companies, government policy impact on companies. So uncertainty regarding tax policies, government spendings, and regulation can make it harder for companies to plan and forecast future earnings. All right. So when investors are uncertain about how political events will affect corporate profitability, they may react by selling or buying stocks, contributing to market volatility. The number four is risk aversion. Risk aversion. So this would lead to flight to safety. Flight to safety. So during times of political instability, investors often shift their assets to safer investment like bonds or gold, which can lead to a sharp drop in stock prices. The more people abandon equity, for other safer investments, the more the stock price will plummet. Stock prices will go down. And so this flight to safety can exacerbate market volatility as capital flow rapidly. Usually capital will flow, rapidly between asset classes. Then there is higher risk premium. There's higher risk premium in this context. So investors demand higher returns to compensate for the risks posed by political uncertainty, leading to increased volatility in stock prices as companies and sectors are reevaluated based on their risk profile. Then number 5, geopolitical risk. Please subscribe to this channel, like this video to do me a ton of good. So geopolitical risk, in this case we're talking about international impacts. That's geopolitics. We are considering international impacts. So political uncertainty in one country, particularly in large economies or emerging markets, can have global repercussion. It can have global repercussion, global impact or influence. So geopolitical tensions such as trade wars and conflicts or diplomatic crises can disrupt global supply chains and economic relations, leading to heightened market volatility. Number 6 is policy shifts and regulatory changes. Policy shifts and regulatory changes. When it comes to regulatory uncertainty, political changes often leads to shifts, in a regulatory environments. For example, changes in trade policies, labor laws, or environmental regulations can impact industries differently. So investors may react to the uncertainty surrounding this shift, causing fluctuations in their stock prices. Number 7 is election and political transition. Elections and political transitions. So let's consider election outcomes. So elections often bring uncertainty as market participants weigh the potential impacts of different candidates or political parties. The possibility of a major shift in policy, such as changes in taxation, government spending, or foreign policy, can lead to volatility, as investors adjust their expectations and accordingly. Then transition periods. Apart from the election outcome, there's also the issue of transition periods. So the transition periods, between political leadership changes can also create volatility as market adjusts to new governance and potential policy changes. And then lastly, number 8, lack of confidence in government institutions. Lack of confidence in government institutions. So in this case, we talk about government dysfunctional governments. So political gridlocks, corruption scandals, or loss of confidence in government institutions can trigger sell-off. So investors may fear that political instability will hinder effective decision making, leading to economic stagnation or decline. And so, whether we like it or not, political uncertainty will definitely affect the markets. It controls market behavior and also, kind of regulates investor, confidence and even sentiments.